Hello and welcome to CIO Perspectives. I'm Sid Ahl, the co-CIO of Private Clients, Endowments, and Foundations here at Brown Advisory, and I'm joined today by my co-CIO, Erika. We're excited to have with us today Vineet Mitra, the Chief Investment Officer of Ward Ferry, a $3 billion specialist in Asian small and mid-cap company investing based out of Hong Kong and Singapore. We've been invested with Ward Ferry since 2005, and there are a number of topics we hope to hit today with Vineet, from the new excitement in Japan surrounding their corporate reforms, the opportunities and risks in China and India, and what he's also seeing in Southeast Asia. Hopefully, we'll get a better idea of the case for investing in smaller companies in Asia, in a market that remains hyper-focused on U.S. large-cap technology companies. Stay tuned after our conversation with Vineet, when Erika and I will reflect on our takeaways. So, Erika, you ready for a whirlwind tour of Asian markets?
I am, Sid. So many of these regions are top of mind for investors, and I'm really looking forward to digging in today.
Terrific. Vineet, welcome to the pod. Thanks for joining us.
Thanks for having me.
For our listeners who haven't known you for the last 20 years as we have, why don't we start with a little bit of your background? How did you end up in Hong Kong picking small cap stocks?
I think like many people who come to Hong Kong, these things kind of happen by accident. So I came out to Hong Kong 26 years ago as a management consultant from Toronto. And I thought I'd spend 2 years here, and it's been 26. My career then moved from management consulting to private equity, where I got a taste of marrying consulting and investing in private equity, which I really enjoyed, and did that across several regions in Asia. And then in 2004, I started feeling an itch to move and explored a number of opportunities and got a chance to join Ward Ferry. And back then, we were known for long-term investing, being thoughtful, taking a private equity approach to public market investing, and that's still very true today. And what attracted me to moving to Ward Ferry was the fact that we were taking this long-term approach, but it was also the opportunity to learn public market investing, especially in the small mid-cap part of the market, because we were seeing many private equity firms at that point doing public market transactions, which was curious to me as someone in private equity. So I wanted to go and learn that. And I also wanted to get more of a regional experience set built. And what attracted me really to the small cap part of the public market opportunity set was the fact that we're still in the early stages of wealth creation and generational wealth creation, as well as economic growth, middle class expansion, and overall economic expansion in many of these dynamic regions or countries in Asia. And I thought small mid-cap investing was a great way to leverage some of those trends that remain trends that are in place today. And after 20 years almost of doing this, I'm as excited today as I was back then about finding small mid-cap companies that can multiply in value over time by taking a methodical approach to finding them and analyzing them.
Vineet, you have such a great background between public and private markets, and I'm going to throw a couple questions to you all in one. How would you describe your investment philosophy, portfolio construction, and the universe of companies that you're looking at? And then secondly, how do you marry this with varying regional macro environments?
As you might guess, it's simple in answer and kind of hard to do on a daily basis. And it starts with really trying to be disciplined from a process standpoint and disciplined from an investment philosophy standpoint, and kind of sticking through that through thick and thin, as long as you think there's long-term value creation that can be had through your process. So just to take a step back and start with our investment philosophy, let's start with that first. The portfolio really gets built by looking for companies with the following characteristics. We want businesses that have massive addressable markets, hopefully with tailwinds of growth. And in Asia, what's nice, even where you are today after 20 years of economic expansion, you still have considerable tailwinds of growth, and now off of economies that have reached inflection points from a scale perspective, which are truly attractive from an overall GDP perspective, but overall profitable perspective. So large addressable markets. The second characteristic that we're looking for in any company that we invest in are basically businesses that are run with good governance in mind. So we often say we want businesses that have governance, transparency, and alignment with minority shareholders, or improving governance, transparency, and alignment with minority shareholders. Because what you want is to be involved in companies that recognize the power of being a public company, the power of participating or partnering with minority shareholders, and the value creation that can happen if you do both business execution and partnership with minority shareholders correctly. The third thing that we look for, and this is super important given our style of investing, is businesses that can be sustainably free cash flow positive over a period of time, even if at the initial stages there's a considerable amount of investment involved. And then as you reach sustainable free cash flow positive, we want companies that generate higher and higher return on invested capital over time. The companies that really can build franchise value. That's the goal for us every day here when we analyze any company. You asked a little bit about portfolio construction. Portfolio construction is very bottom up. We go around visiting lots of companies each year. We have 1,000 company touch points, and that helps us navigate the different types of businesses we want to find. But before we do that, we do think about things in a more structured way. And so we want companies in the 4 following buckets. So really it's financial services businesses. And when I say financial services, it's not like we're used to financial services in more developed markets. These are companies that are still emerging from a business model or in a growth perspective because they're catering to customers that are still learning how to consume financial services. And that could be life insurance, health insurance, it could be asset management, or it could just be basic deposit giving and lending institutions or retail banking institutions. The second is companies that are focused on technology and media. And what we like to say is really businesses that are benefiting from changes in technology, businesses that are benefiting from building software platforms or e-commerce platforms and an infrastructure that goes to support that. The third opportunity that we look for, or area that we look in, is healthcare. And really for that, it's not innovative drug manufacturers or biotech, it's very basic. It's finding diagnostic laboratories and hospital chains, for example. And the fourth area for us is quite an important area for us as well, which is lifestyle. And that's just a fancy way for us to say consumer. And the reason we call it lifestyle is that there's so much disposable income being created in many countries in Asia that disposable income is driving behavioral changes in consumption patterns, which is resulting in profit streams being increased for certain companies, which is generating higher and higher return on invested capital. We want to go and capture that profit pool that's being generated by lifestyle consumption choices. Now, you asked a little bit about how would we marry this with varying regional macro environments. And our philosophy here, and one of the things that we say quite often is we want our companies to do well despite the macro around them, despite the political environment around them. So the whole idea is that you could say to us that we can't trade our companies for a period of 3 to 5 years or even more, and we were comfortable with that given the quality of the management team, the quality of the business model, the quality of the balance sheet, the opportunity set that they have ahead of them, and the fact that we're confident that they can navigate a macro environment that could change or that political environment that could change ahead of them. So what we tend to do is we're focused on an opportunity set where we think we can find companies that have incredible value creation opportunity over time. And for that, we define it as the companies that have the small mid-cap blend, which is market caps of below $15 billion at the time of inception. And right now, there's about 12,000 companies in our listed universe. So there's an enormous amount for us to do on a daily, weekly, monthly, yearly basis.
12,000 companies in your universe, 1,000 touch points, you said, on an annual basis. It's just such a big universe to get your arms around. How do you source and screen for investments?
It's a significant universe to get your hands around, and it gets even more challenging when you're trying to build a portfolio of 25 to 35 companies where the top 10 is about 50 to 60% of NAV. And so it's really distilling it down. And that's where those 4 key focus areas that I talked about come into importance. And the other layer on that is that we try to exclude businesses that are state-owned companies. We do exclude businesses that are commodity and resource companies, heavy CapEx or cyclical businesses. And so we whittle down that list quite quickly. And if I take the next snapshot below that 12,000, you come to 5,000 to 6,000, and then you can go down from there. And so really the question is, with such an enormous universe, how do you generate ideas? How do you source? And there's 4 primary ways for us. So the first is the focus areas I just spoke about. And coming back to something I said earlier, everything has to have those 3 characteristics, right? If you don't have those 3 characteristics I talked about earlier, we quickly discard opportunities. The second is we've been doing this a long time, right? We've been doing this now as a firm for over 20 years. And with that comes a lot of institutional knowledge. And we're able to quickly go analyze ideas and either rank them in terms of importance to focus on them or discard them. The third way we do things, which will sound maybe a bit strange, but we invest in companies for such a long period of time. What we end up doing is generating a partnership with the management teams. And as we build that partnership, we're able to go to these management teams, often their owner operators of businesses, and ask them, which entrepreneurs do you respect? Which CEOs do you respect? Where have you invested your money? And sometimes that catalyzes ideas as well. The fourth is that we sometimes, and often have done this, have good experiences with certain business models in, say, places like Indonesia, the Philippines, and we'll go to India and look for those type of business models, or vice versa. Or we once had an investment in China wealth management, and we're looking at the trends that are happening in wealth management in China, and that catalyzed our focus on finding opportunities in wealth management in India, for example. The last part of this process is really the smallest part, which is screening, right? From time to time, we do run screens, and it's really nice to see which companies have performed the worst year to date. And sometimes we're able to go look at that screen and then look at and identify companies quite quickly. And because we've met these companies many times, say over the past 10 years, say, oh, that looks like an opportunity here. This is what we know about this business over 3, 5, 10 years. Let's go look at this because it seems that people are negative, but it's really a cyclical reason to be negative, not a structural reason to be negative. And that also brings up ideas for us.
That's really helpful. I'm curious, in the 20 years that you've been doing this, how that process might have changed, whether or not there are now certain industries or business models that you won't invest in because of lessons learned or what have you, or if you've tightened your focus on quality or governance or any of those factors more over time. Like what has the 20 years really taught you in terms of focus?
We're definitely more concentrated than we were 20 years ago. And I think that comes down to being comfortable with what you don't know. Even if there's upside there, it's better just to stay away from it. Or where you think there's a probability or a chance for monetized losses to be greater than you're comfortable with. And so we stopped investing well over a decade ago in commodities and resource businesses, for example. We moved away from cyclical businesses because I found, at least from my experience, that was a very short-term driven type of investment. And for us, we're trying to capture long-term value creation of businesses. And so everything that we're doing here is set up to do that long-term value creation opportunity. And one of the questions we ask ourselves all the time is, will this company compound its economic value by 15 to 25% a year in, year out, over a 3 to 5 year basis without a cliff, right? Because the cliff can result in a lot of dislocations from a valuation standpoint, for example, at the end of that 5-year period. And so as you start thinking in a very disciplined way about what kind of works for you, what has worked for you in the past, what you think will work in the future, and where your strengths are, it's then quickly, at least for us, easy to eliminate the things that don't work.
Yeah, I'm sure it was even harder to do that 10 or 15 years ago when energy and some of these cyclical businesses were such a dominant part of the market.
Like all of us, we learned the hard way. And that 2008 experience where some of those businesses couldn't get financed with debt capital markets or equity capital markets really, for us, catalyzed that change. And the whole idea is that if you said to us, we could not trade our portfolio for the next 3 or 5 years, I would say no problem, because of the characteristics of the companies from a balance sheet standpoint, a market position standpoint, return on equity perspective, growth, and these companies are in a position to self-finance themselves and take advantage of market dislocations. We didn't want our businesses to be subject to the volatility that happens from time to time in debt capital markets and equity capital markets, especially in this part of the world.
That's really helpful. Maybe we could move on to the question that I think is on a lot of investors' minds, which is, to put it bluntly, the why bother invest in Asian small caps. It's particularly interesting right now because there's a why bother invest in anything but US large cap tech companies and those being driven by AI and the cloud. What do you see as the opportunity in Asian small and mid caps today? How does it relate versus your history in the space, in terms of the quality of the opportunity? I know it's hard maybe to compare it to US small caps because you're not focused there, and maybe we can share some of our views, but how do you think about it today?
It's been a frustrating period of lack of interest, or that movie title, He's Just Not That Into You. And I think that sometimes we ask ourselves as a team, like, okay, why do we keep banging our head against the wall? And then we kind of pull back, look at the setup we have today in some of these small and mid-sized companies that we own, the valuation characteristics, and kind of 2 things I think really stand out to us, or 3 things actually. So the first is, we do believe that fundamentals matter, right? And over time, fundamentals will be recognized from a value creation standpoint. And if that belief is there and that dislocation that, say, is creeping into some parts of the market doesn't remain structurally, I think we have an enormous upside for our portfolio and the Asian small mid-cap space over time. Now, the next two things are, if you're able to buy types of businesses that we are characterizing as small mid-caps today at these valuations, that looks like an amazing opportunity. And when I say with these type of characteristics, what I mean is like, the small mid-cap today in Asia is not the small mid-cap, for example, that you're seeing in more developed markets. These companies are number ones and number twos that we own in their spaces, and they're characterized today as small mid-caps, at least as we characterize them, below $15 billion in market cap at the time of investment. So you have businesses that are number ones and number twos that are growing at 15 to 25% a year, if not stronger, that have had 5 to 10 year track records of growing at 15 to actually 40, 50% a year in some cases. And we think will compound at 15 to 25% over the next 5, 10 years, that have reached scale points of profitability that are in markets where GDP per capita, for example, in India, is starting to approach $3,000 per capita, which is that magic inflection point. We think that as you look forward, these companies become more and more relevant from an investment perspective, from a marginal investor attention perspective, and they're just unrecognized and kind of just undercovered today. Now, the third part of this is the valuations. When you're able to buy businesses that are trading well below, call it 1 times PEG on a 3-year perspective, it's price to earnings growth, right? So effectively, the PE you're paying for the growth that you're getting, and we look at over a 3-year perspective. And if you're buying it less than 1, you have a very healthy margin for safety, right? And let me give you some data points here. Our portfolio right now trades on 23 to 24 times forward earnings. We think the 3-year compound growth rate is going to be around 40% a year. More importantly, coming back to something I said earlier, as you go past the 3rd year into the 4th year, 5th year, and 6th year, you're going to be in that 25% range. So it doesn't really collapse, right? That's quite important. You're not kind of bringing forward and pushing growth in the near term to try to capture kind of near-term upside. You're still focused on that fundamental long-term opportunity. And then as you look at the characteristics from a free cash flow perspective and operating cash flow yield perspective, you're seeing our portfolio is generating an operating cash flow yield of around 7% and a free cash flow yield of around 5%. And then ROEs of over 20%, or just actually under 22%. And here's the last part of it. These companies really don't need capital to deliver that growth that I'm talking about. And so 85% of our NAV today is invested in net cash companies. So if I told you you could buy a leading company with these type of valuation characteristics, I'm pretty sure it'd be pretty attractive to that, especially if I told you, hey, the following year, you're going to have an operating cash flow yield of 9.3% and a free cash flow yield of 7% almost. So that's quite exciting because the growth will continue. So when you kind of look at this construct, you could hold a multiple constant and just have meaningful upside from the compounding of the earnings, right, of the portfolio. So that's, I think, a really interesting dynamic right now. And that's why people should focus on these markets, because it's not investing in the 4th player in the market or the 5th player in the market. It's really the number 1 or number 2 player in the market.
It's really interesting. If we look at the U.S. small cap space, which on a high level looks attractive relative to U.S. large caps from a valuation perspective, considering the quality, et cetera. When we look at your universe, valuations are meaningfully cheaper, 24 times forward earnings versus, depending on what you look at for small cap growth companies in the US, 30, 40, 50 times earnings. The growth that you mentioned, it's probably double that of what we see in the universe or more. And then the free cash flow yield that you quoted is more than double the free cash flow yield that we're getting. So it's interesting. I mean, you can ask the question, what should the discount be for Asian stocks versus US stocks? Certainly by historical standards, it looks quite high right now for these types of companies. But how do you rank it?
This is going to sound probably a bit strange, but I actually don't think there should be a significant discount rate for these businesses that I'm talking about, because you're number 1, number 2 in the market, you're at scale, you're going to compound at the rates I alluded to earlier, and you don't need cash to actually deliver your growth. It's a pretty powerful place to be. And, I think that needs to be considered when you're looking at some of these businesses, especially if you have liquidity. And for many of these companies, liquidity is getting healthier. And that's just a natural byproduct of the way these markets are evolving, will continue to evolve with more domestic support and scale over time. So I'm not sure the discount rate should be that significant relative to what you're seeing in the US. I mean, clearly, the way we think about it, you have to look at the various discount rates, their cost of capital that's in each economy that you're looking at, because interest rates are a country that you're looking at, because interest rate policies are different. So we look at all that stuff. But, if you pull up and just look at these valuation characteristics and the growth ahead of these companies, and then your ability to forecast them, hopefully with a decent hit rate, I think that supports our view, at least, that the discount rate doesn't need to be that significant. But the other thing that I do, for example, just to give you a sense of how we think about things, is I actually don't really like DCFs at all, because you can play around with the inputs to get kind of whatever output you want. And so we always ask ourselves, what do we think is a fair value to pay for this company if we couldn't trade it? What will we be comfortable with, and why? And then you get into a pretty detailed, complex discussion about why you're comfortable, for example, say paying 20 times earnings for something, or 15, given the growth that you're going to get ahead of you. And then how does that yield compare to, for example, the risk-free rates in these different places that you're investing in? So we do think about those things, but I don't really think about it in a way, should this be at a premium or require a discount rate that's higher than what's available at, say, for example, companies in the US.
You don't boil it down into a discount rate of future earnings in a DCF where you're adding a risk premium for these markets.
I don't. I mean, that's embedded, right, with how I think about things. If you're buying things below 1 times PEG, and if you're buying operating cash flow yields of 7% and free cash flow yields of 5%, and compounding off of that, and then in many respects, you're getting dividend yields as well from companies doing more and more capital management and with buyback dividends, all that kind of plays into our thinking.
On that thread, are you seeing a tailwind of improving corporate governance and how that's impacting financial performance across regions?
Definitely. Taking a step back, I think governance overall has improved considerably over my last 19 years, almost 20 years doing public markets, and then a little bit more time than that doing public and private. And you just see it, right? You see it across the board in terms of level of disclosure. You see it in terms of regulatory oversight, and the sophistication and maturity of regulators just improving year by year. And that's across all the countries that we invest in. And so I do think that's a nice tailwind. And then you also see it because, as you all well know, generational change happens. And as generational change happens, especially with a lot of family-run businesses that are listed in Asia, that next generation usually comes with a different view about how to run things based on their reference sets or educational backgrounds. And that does also typically result in governance change for the positive. And there's been many examples of that we've experienced positively in our portfolio, and that we've also just seen by being in these markets, looking at lots of companies.
Maybe we could ask just a question. A lot of our listeners are going to be looking at the US market day to day and might be curious if you're seeing some of the same dynamics that are so dominant here. Concentration in the largest companies, a shift to passive investing, small caps underperforming but appearing undervalued, and maybe the trading volumes day to day making a little bit less sense than they used to, kind of dominated by shorter term investors, hedge funds, quants, et cetera. Are you seeing these same dynamics in Asia?
We're seeing some of it. I was trying to get some of the passive data, but it was proving a bit elusive. I don't think passive, ETF style investing is really as something that's super prevalent here yet. I'm sure that will change over time. Definitely mutual funds and domestic equity plans have grown in relevance, and that's causing some skews in certain markets, which we're aware of, and you have to be cautious of when you're looking at some of the valuations presented to you as a result of those skews. What I will say is there's definitely a similar dynamic playing out in Asian markets in terms of concentration of returns. And it's not that we have I think it's the Mag 7, we call it in the US markets, but we don't have that here, but we have this concentration of returns. And I was looking at some of the data here, and if you look at that, for example, in Japan, right, 5% of the top X has contributed to 75% of returns this year. And then if you start looking at a little bit differently for other markets and say, look at the top 20 stocks and what percent of returns they've been this year for a number of markets, some of them are well over 100%, right? So it implies that the top 20 have generated lots and the others have just lost money. And that's actually pretty consistent across, for example, Korea, Indonesia, the Philippines, Malaysia, and Thailand. The one market that's most balanced is India, where say the top 20 is about 50% of the year-to-date return, and the rest of the market's the other 50%. But that's also a result of a phenomenon in India today. And part of the reason folks are excited about India is that systematic investment plans, which are basically retail money, is now putting in approximately $5 billion. That, combined with other domestic flows, is approximately contributing $5 to $7 billion a month into Indian equities. And much of that has been going into kind of the mid-cap part of the market. This kind of dynamic to us, for example, is frustrating because it just means that the value that we see in the small mid-cap part of the market is not being recognized by public equity investors. So it's great in one respect because more and more margin for safety is building. There's like more and more upside and we're able to allocate more capital to these companies, but it's still frustrating. The only market where things are a bit balanced, where fundamentals, where stock prices are following fundamentals, sometimes maybe excessively so, is India.
And some of that frustration is actually pretty similar to what we've seen in the US. I mean, US small cap has been a bit unloved. And one of the drags on US smaller companies has been rising interest rates. But there's also been lofty earnings expectations, which have come down to more realistic levels. But smaller companies in the US tend to have greater leverage, greater debt. A higher portion of that is floating rate. How would you describe the balance sheets, the financial flexibility of companies in your universe?
In our universe, or the companies that we find most attractive, you'll not be surprised when I say actually the balance sheets are quite healthy. But when I just try to pull it back a little bit, and if you look at India, for example, India went through its credit stress most recently, I think in 2018, if I'm not mistaken. So companies have come through that. The bad companies have suffered clearly, and some of them have been able to recapitalize. The good ones have gotten stronger. At the same time, because of COVID, banks were forced to raise capital, increase their capital adequacy to make sure they have buffers. So when we look at India today, there's not a pervasive, I think, debt problem at the company level. Consumer credit has grown, and that's something to watch. But you don't see those kind of like debt challenges, I think, at a company level that you do in some of the other markets that you described. And then if you go into other parts of Asia, I think it's a similar story depending where you're looking, right? So clearly, if you're in China, obviously the real estate companies and some of the heavy manufacturing businesses will have a lot of debt. Real estate is not a surprise to you. The heavy manufacturing businesses likely because just a slowdown potentially in export growth. And so we just generally stay away from that. A lot of work has to happen, I think, in that part of the market in China to resolve some of the debt issues. But then conversely, if you kind of look at some of the companies you're able to buy, some of the leading companies in China, you can buy them with 30, 40, 50% plus of the market cap in cash. And these companies are now doing buybacks, giving you dividends, and still growing. They call it 15 to 30% a year. Some actually a little more strongly than that. So that creates an opportunity. And then when you look at the other parts in Southeast Asia, it's kind of a mixed bag. Japan, it's just starting to increase interest rates. We'll see how actually that plays out for some of the companies there that have gotten used to low interest rates for zero interest rates for a long, long period of time. And so I think the answer is I can't really describe it in one sentence or apply it in one sentence. They're all kind of unique situations. But on balance, I don't think we have that same view here that you do when I read some of these strategist reports in the US, that the interest rate cycle is going to result in a significant upswing in small mid caps because of the alleviation of pressure on their debt costs. I think what's going to happen here is that as the interest rate cycle starts to moderate a little bit in developed markets led by the Fed, that might catalyze more interest, for example, in these markets. And so Sid asked me about discount rates earlier. Well, suddenly if the Fed's at dropping it from 5 and below, and suddenly you say, oh, that's generating a 5% free cash flow yield in US dollars, call it, and you're growing that at 15 to 25% plus a year, that becomes a little bit more attractive. And then, I was reading something this morning and it was saying that actually the Indian economy has grown at, I think, just over 9% in US dollar terms over the past 2 decades, I believe. This person who was in here this morning, we were chatting about just India top down. That was one of the data points that came up.
I'm curious, I think you've quoted to us in the past 85% of your portfolio is net cash balance sheets, no net debt. You talked at the beginning of this about your journey starting off with a private equity lens and becoming interested or noticing that private equity was becoming interested in public markets. Do you think that with companies of this quality, with clean balance sheets available out there, that private equity might become more interested in some of the companies in your universe? I mean, the industry's developed so much over the last 20 years, a lot of dry powder, et cetera. Could that be part of the story?
Absolutely. The private equity, I think folks will become more and more interested in some of the public market valuations available given the quality of the companies, but also the quality of the balance sheets. and the prices that, as I started with, that are available today. That's a double-edged sword for a minority public market shareholder because as that bid happens, you feel good for a moment because you get a nice, say, near-term, hopefully upside, but the long-term value creation opportunity you thought you had ahead of you is taken away, right? So there's a fine balance to that. I think the counterbalances to that actually happening from a scale perspective in many of the markets that we invest in Asia is that there's still a lot of family-held companies. And these companies are choosing to go public rather than entertain taking capital from private equity because of regulators and different stock market stakeholders are offering them or encouraging them to get in terms of tax benefits, other things that they can get if they go public. And in many cases, these companies are still in the first or second generation, maximum third generation of family stewardship. And as they also say, wealth creation. So they don't necessarily want to give controls or rights to private equity and they choose to go public. And so I think those businesses will be harder for private equity folks to take out. Where there's going to be opportunity will be like professionally managed businesses. I think in Japan, you might see some of this stuff happen given what's going on there right now in terms of the value unlock that's starting to happen for corporate governance reforms. Most likely in Korea. Australia, you've already seen it. And then selectively, I think you'll see it in some professionally run firms or where you have just generational change in family where the next generation doesn't want anything really to do with the business. The one thing that we're doing a lot with the companies that we own is trying to guide them how to be a better listed entity, how to be a better public market company, and giving them advice where they're willing to chat with us about it, about how to improve investor relation efforts, how to communicate, what the long-term upside is from a value creation standpoint, talking to them about the importance in a market like this will dovetail nicely into the China question of capital management initiatives when you have such financial flexibility on your balance sheet and generating free cash flow and you have a net cash company, for example, and you're still able to meet your CapEx needs with your cash generation of your business. So all this stuff kind of plays into hopefully these companies realizing that there's a long term ahead of them and that they can just get a little bit, I'll call it more proactive about how they're managing their investor relations effort, how to think about capital management. And maybe that will catalyze investor interest to help in a re-rating, for example, for their stock price. So they feel also a little bit better and look forward and can defend against potential inquiries by private equity if they don't want those inquiries. So we do some of that. Actually, I think we do a lot of that, not some of that.
Maybe we can shift to talking about some of the individual regions you focus on. I believe you break it down into the four big segments: China, Japan, India, and ASEAN. If we start with China, you've been spending a lot of time there recently. I think you just came back from a trip. And it's still a pretty small part of your portfolio if you compare it to how big it is in the benchmarks. But how are you approaching China today, given what appear to be pretty attractive valuations, but an economy that's still struggling and with pretty heightened regulatory and political risk, and just generally pretty uninterested investor appetite?
I think one word answers this question, which is cautiously, and I'll expand on that. And the cautious part is because there's a number of issues that you highlighted that still haven't found resolution. The things that have found resolution or nearing resolution, maybe from a marginal investor standpoint, is that for the folks that we speak to, it seems that the majority of the marginal selling is done, right? In terms of that was triggered by, say, concerns around the economy, geopolitical concerns as well, and as a result, repositioning China, and then complicated by concerns that stimulus is not going to happen. And so this could be just a long recovery. And there's just better things, for example, to do. And so the way we think about it, and I get asked a lot why we still care about China. And besides having still approximately 15% of the fund there, the way we think about it is that I think in my career, at least, I've not seen a combination of scale, fundamentals, and valuation come together as they have in China today. Which, as someone who is a fundamental bottom-up stock picker and who gets excited about these things cascading together, it does, I think, deserve cautious interest from us. And then the question is, well, how do you get comfortable allocating capital there? And how will you think about that from a portfolio management standpoint and construct point? And so for us, the answer has been keeping it at a judicious level, and that's 15%, and being very cautious about how we manage that. Having a high bar to put anything new in the portfolio, and making sure that what we own in the portfolio or are looking at as potential additions to the portfolio answer the following four questions positively. And this is going to sound, I think, fairly simple, but I think they're very important questions. So the first is if the company you're looking at does well, will it be broadly good for SME growth? So SMEs are a big driver of the economy, a big focus area for the Chinese government as well. And it's important that if your business succeeds, that doesn't cause harm to the SMEs. The second is, if the business is successful, will that be broadly positive for employment? Because again, you look at where we are right now from an economic perspective in China, and unemployment rates, especially youth unemployment rates, they stopped reporting the actual figures now, are quite high. The third is, if this company is successful, will it broadly be additive to fixed asset utilization? As we all know, China wants to move more and more to consumer-led economy and less dependent on fixed asset investment. So that's the reason that we think it's important to answer that question, yes. And the fourth is, if this company is successful, will they be broadly additive from a lifestyle experience from a consumer standpoint? Will this company cause any anxiety? So what that means is, will they be viewed as profiteering? So you need to ensure there's reasonable margins, but also offering at the same time a good experience, a lifestyle experience to consumers. So that's how we think about it. So let's just give you some examples. Today in the portfolio, we own the leading hotel business in China, which is a company called H World, which we've owned for over a decade. And hopefully we'll own for the next decade. And again, that's a company that's started with budget hotels, moved into mid, and now is in more higher end hotels. And as you kind of look forward, you see this business continue to compound, call it the mid-teens, trading at a 12 times forward EBITDA multiple with 15% of its market cap in cash and giving you 7.5% now dividend buyback combination, so capital management yield, which is quite exciting. And we know this business quite well and got to know them from a management structure perspective really well, but also just from a business process perspective incredibly well. Another business we own is the Uber of long-haul trucking, for lack of a better example, in China. And this business is just starting its monetization journey. But as it does well, the experience of its customers, which basically on one side, supply side, are small, medium enterprise businesses because they're truckers, or micro, small, medium enterprise businesses, or sole proprietors. If this company does well, those businesses have higher income because the utility of their trucks go up. At the same time, the shipper side has a better service experience. So this business today has over 55% of its market cap in cash, has just started embarking on a buyback, is trading on 7 times X cash PE with well over 30% growth. Right? So, and again, it answers each of those questions, yes, that I talked about. And the other two businesses that we are focused on, jobs or classified job business and a hot pot chain.
Maybe I could jump into the Uber of long-haul trucking. How competitive an industry is that? And does it have the same kind of network effects that we've grown to finally appreciate after, a decade of competition for companies like Uber and Lyft?
It exactly has those network effects. Its market share is quite significant. It has basically well over 80% market share, and it's just starting its monetization journey. And that's why we're so excited about it in terms of its upside potential, even in a tepid economic environment, because of just the opportunity that it has today from an overall revenue growth perspective, driven by just increasing monetization a little bit, and the multiple of basically profits that will happen over the next 3 to 5 years as a result.
You kind of hit on the things you're looking for. These companies in China have to be good for small businesses. They have to be good for the consumer. They have to be healthy in some way. They have to be creating jobs. Maybe you could comment a little bit on the importance of, or your focus on, domestically oriented businesses versus those that are export oriented. And you could just tell us how worried we have to be about tariffs and their potential impact on companies in China under a potential new administration in the U.S.
Yeah, we're very much focused across the whole portfolio, and China's no exception, on domestically driven businesses. Because again, what we're trying to do is keep it quite simple from an investment process philosophy standpoint, and to be able to answer that question, yes, that I posed earlier, which is, if you said I couldn't trade this portfolio, would I be comfortable owning it for 3 to 5 years? And you only could do that if you basically set a set of parameters on it, which makes each company looking at have kind of 3 to 6 key variables to analyze. And we want to increase our analytical ability for each of those variables and make sure that we are not walking into areas where it's hard for us to get a differentiated point of view. I think export-driven markets are somewhat like that, because it involves figuring out customer trends all over the world for some of these companies. And in this case, with China, I think the really important thing to realize here, and the key thing about spending time in China, is that the Chinese consumer still matters, right? Very much from a global economy perspective. And the Chinese consumer still matters, specifically very much from an Asian economy perspective. And so many times we're looking at Japanese companies that have a considerable amount of their demand coming, for example, from China. And so we are constantly spending a bunch of time in China to answer some of these questions that have to do with what the Chinese consumer may do from an incremental demand perspective across different products and services to see how that's going to impact certain companies we're invested in. And I think that's quite important to always be on top of. Now, your question was specifically on tariffs, and I haven't answered that yet. And that's just because I don't really have a good perspective, I think, on tariffs bottom up and how they're going to actually impact certain parts of, I guess, the demand environment in more developed markets, whether it be Europe or whether it be the United States from an inflationary standpoint, which is, I think, kind of what you're getting to. The reason I don't have a good answer for you is because there's been a lot of movement over the last 1, 3, 5 years of supply chains out of China to make sure some of these companies can get around tariffs, which is why I don't have a good answer for you about how that's actually going to impact developed market consumers.
One more question on China, and then I know we want to move on to some other regions, but your cautious interest to me sounds more like curious interest. So what's the inflection point for you to add to China?
One of the things that we are trying to answer by spending a lot of time in China is when will Chinese companies and Chinese entrepreneurs start increasing their investments in China? Like, when will they start buying companies or consolidating markets because they believe that not only is a valuation opportunity set compelling, but they'll be allowed to earn a good rate of return on it over 3 to 5 to 10 years. And that is the key data point that we're looking for. I mean, clearly we all see CPI data and how that might be bottoming and maybe moving up a little bit. We can all talk to shop managers and stuff like that and get their feedback. You're talking to companies all the time, but it's really that part of it, which I think is the hardest part to actually see. And so short of broad-based stimulus, which people don't really have high hopes for, although given the experience from how China changed some of their COVID restrictions very quickly in December of 2022, I believe that could change quite quickly. But short of that happening, where there's not a lot of expectation for I think that what we're doing is just kind of spending a lot of time there and trying to see if we can piece together some of this answer that is talked about, where people are actually increasing their rates of investment. It's all good to get money back from companies and they're giving you an excuse to wait, which is wonderful. But what you really want to see is, please put the dividend policy in place, do the buybacks, but also go increase your capital expenditure plans, go increase your investment plans, because you have confidence in the next 3 to 5 to 10 years. And this is an incredible time to do it because assets are cheap, locations are plentiful, labor is there to be employed, and you're now looking at maybe a global economy that might be getting a bit better if interest rate policy influences that.
Maybe we can shift gears a little bit and talk about India. I think you just recently spent some time in the region, and there's an opposite dynamic that's taking place there. So valuations appear elevated by historical standards as investors have moved capital out of China into places like India. And there's been this reset from a political standpoint, but there's also huge workforce issues. How are you approaching India today?
India has been a large part of our portfolio exposure since the inception of our funds. And I anticipate that will remain the case for the next many years because of just the top-down and bottom-up opportunity set in India. And one of the things that we have always been attracted to in India is the quality of the entrepreneur in India and the ability for these companies to be built with a cost structure that allows them to generate significant ROEs and profit margins by selling goods and services that are well priced for the Indian consumer, right? And that's not an easy thing to do. And you can take that dynamic and apply it to a financial services business or a hospital chain or life insurance or health insurance or motorcycles, cars, like anything you kind of want to apply it to, which is why we're excited about that. And I do think that India goes through periods of exuberance and pessimism. And right now you're in a period of, let's call it optimism and maybe pockets of exuberance. And I think that people have to have a discerning eye when they look at India and not just get caught up in the thematics of manufacturing or the thematics of CapEx-driven growth or public sector companies right now, because there's so much to do. Like the investable universe in India is, call it 2,500 listed stocks on the main board and 2,500 listed stocks which are on an SME kind of board. So there's like 5,000 listed stocks. And there's just a lot to analyze in India. And as you go past some of the businesses that are trading at exorbitant valuations, you can find companies that are trading at actually pretty reasonable valuations relative to their near and long-term growth rates, which we find quite compelling. And I do think, as I said earlier, you do need to have a little bit of caution because India is trading at, on a market standpoint, when you look top down at higher multiples than have traded in the past, both on an absolute basis, both on a market cap to GDP basis, and definitely on a relative basis. The relative one you can explain a little bit because clearly it's driven by China coming down, as you articulated a little bit earlier, Erika, and also by ASEAN markets also coming off, right? So you kind of see some of this dislocation driven by some of the derating of those markets. But if you just think about India overall for a second, India has always had higher valuations. And it's had higher valuations because the ROE of the market has been higher than other markets, right? That drives some of the higher valuation. So when we look at it today, we're still finding that there's lots for us to do in India. We've been trimming companies that we think have gotten to elevated valuations where we can't justify the mid and long-term upside that we need to hold in the portfolio at the scale it was. So you've kind of been trimming those. And we've been adding to positions where actually it seems that investors have lost relative interest, right? And I know you talked a little bit about, say, India benefiting at the expense of China. But if you actually look at the foreign flows up until recently, where they've kind of started increasing post the election, the foreign flows were a bit tepid. Actually, foreigners were net sellers, I believe, if I don't have this incorrect, I think last year. And it was really the domestic market that was upholding the Indian stock market. And so there is a demand-supply imbalance right now. Household equity or household participate in equity markets is about 6 to 7%. That's less than half of where it is in more developed markets. It's less than half of where it is in some of the Asian markets. So that's going to increase over time, which is causing what you're seeing right now in terms of dynamics and some of the domestic flows into markets. I think that will remain stable. But that also has then, for folks like us, created an opportunity set in areas where the domestic folks are not, say, so excited. For example, in financial services or in consumer lending, in life insurance and health insurance and classified businesses and hospital chains. And so we're still finding a lot to do there. And just having come back from India when I was in Delhi last week, where I met 25 companies over 3 days, we came back with more ideas than we thought we would, and companies that actually look fairly dislocated or haven't done that much. And so that's exciting for us. And I was expecting that I wouldn't come back with that many ideas. And the other thing I came back with, and this is going to sound really qualitative, but I think it's an important point, is that there just seemed to be an increased level of, let's call it level-headedness by owner-operators about how they're going to manage their businesses from a funding or debt equity composition perspective, and making sure that they learn from some of the issues that happened in the past credit stress in India. And that was also, for me, quite nice to hear, right? Because when you get to periods of, say, optimism like we're in today, or exuberant, where periods get a little bit exuberant, you want folks to have hopefully learned from the past to ensure that you don't get massive periods of volatility on the downside, right, going forward. So just to give you, put that into some examples. We own a hospital chain in India that we think is going to compound its EBITDA by 25% a year, probably for the next 5 years. And that business today has 22 hospitals, between 4,200 to 4,300 beds. And both the beds will grow and the number of hospitals are going to grow over the next 5 years. And Indians don't have a health insurance safety net. That's starting to build, which is why we like health insurers in India. So people are making choices to go from public hospitals to spend on private hospitals, right, which is driving demand for a company like this. And its service quality is phenomenal. And then for people with more disposable income, they're making the choice to go more and more private, right, which is also driving demand, and have different types of services done at the hospital, which is driving average revenue per bed growth, right, for companies like this. So that's one example, something that's been in the portfolio for a long time.
And what's the name and the valuation on that one as well?
The company's called Max Healthcare, and the business is trading on a forward EV/EBITDA basis of just over 30 times, and it has an ROIC of over 20%, has basically a neutral balance sheet. It was net cash. They're just doing an acquisition. So might go to net debt, and then they'll generate cash to get back to a more neutral position. And a couple other companies, we own a business which is India's leading consumer finance company that we've known for over a decade. And the company is called Bajaj Finance. And over the past decade, it's grown its revenue almost 31% compound average growth rate, it's profit by a 35% compound average growth rate. And we think as you look into the next 3 to 5 years, the revenue growth rate will probably be in the 25 to 30% range, and the earnings growth rate will probably be in a similar range. And for us, that's exciting because as we look at the next 5-year period, so kind of add another 2 years after that, we see similar types of growth. And this business today, given where some of the skews are in the market, this business today is available at 20 times forward earnings for about 25% compound growth with no need to raise capital, and an ROE which is hovering around 20% or just above 20%.
Maybe we could shift to talk a little bit about Japan next. And we've been spending a lot of time looking at the region just because of what appear to be an attractive set of conditions. So corporate reforms, the potential to improve on relatively low levels of profitability and efficiency, improving consumption as Japan exits the decades of deflation that they've had, and then finally cheap valuations. Is the opportunity set as attractive as it appears to us? Do you have any concerns after the short-lived but violent market correction we saw when the yen carry trade was unwinding? What are your views on Japan?
Yeah, we do think the market opportunity is actually quite attractive in Japan. And we think that for a few reasons. And then I'll talk about why some of the optimism probably needs to be tempered a little bit. The reason that we're excited is that the reforms that folks are excited about, if you think about to the genesis of those reforms. This wasn't March 2023 when people got excited when it was announced that the Tokyo Stock Exchange was going to encourage companies, basically hold them accountable, to find their cost of capital and figure out how to generate return above cost of capital and make sure if you're trading at below price to book, you do everything possible to get yourself at to price to book or above. And so that is what catalyzed this interest in the market. But the reason that we're excited about it is that this change has been done in a very Japanese way, which has been long-term and quite methodical the way it's been put in place. So it really started kind of over a decade ago. And now where we are today is that 85 or 86% of companies in the Prime Index have basically released their plans to do this. And those companies they call them respondents. And those company names have been identified. So by basic definition, the ones that haven't have also been identified, right? And so that's this kind of like name and shame thing or reverse name and shame thing. And in the standard index, 44% of companies have basically responded and given their plans. So that's all quite positive. And I think that's going to drive kind of structural probably change from a corporate governance standpoint, attention to capital management, reducing laziness of balance sheets, reducing cross holdings, ensuring companies do something more productively with the capital that they have. I do think that what needs to be tempered a little bit is the expectation of the rate of change, right? And these companies are putting their plans together and some of them are making changes, but I think to expect the large parts of the market to make changes within a year or 2 years is a little bit, I think, too optimistic. I think it'll just take some time. And a lot of the positioning that you've seen as a result of people's excitement, and also, Erika, you talked about India benefiting from lack of interest in China. Japan has also really benefited, even more so than India, from lack of interest in China. It was very much folks who was finding all these low price to book companies and putting capital there, and you were making money not only in stocks, but you were also making money on both the movement of the yen, but also the structure you put in place to hedge the yen. And so it was this great place to be until the Japanese retail investors were obviously selling yen to buy their US stocks. And so all this kind of came undone in the latter parts of July, the first week of August, culminating in August 5th when you saw this massive move in the Japanese stock exchange and also the yen. Now, we always were of the view that little people are a little bit too optimistic and there needed to be a reset. So actually for us, we're happy is the wrong word, but from a market stability standpoint, and I think medium, longer term health standpoint, we're happy this kind of reset happened. And what we did during that day and the lead up to it was we were actually buying a number of companies in our portfolio. And so I do think that, when you look at Japan today, the reason that we're excited is not so much the reason that other folks are excited while we believe in the change that's happening. We're excited because the small mid-cap part of the Japan stock market is just being, I think, ignored. And there are actually a lot of really interesting businesses that are building quite compelling long-term value creation opportunities from an ROE standpoint, revenue and profit growth perspective that I just think are not being recognized because of the attention that's being given to some of these low price to book companies and some of these advanced manufacturing companies in Japan. And that's where we're looking. We have kind of 4 key areas we look at in Japan. We look at companies that are kind of consolidating and innovating in these like large addressable markets. And in the past, we've invested in drugstores there. We've invested in, a company which is back in the portfolio today, which is a business that's effectively the Grainger of Japan called Monotaro. This is like not a typo. Over the last 10 years, this company has grown its revenues by a compound rate of 22%, its gross profit by 22%, and its PAT, or profit after tax, by 25%. And if I told you this company is based in Japan and focused on the domestic market, you'd say there's no way, because Japan's known as like a low growth market. And so you're able to find these really interesting companies that are consolidating, innovating in these like large industry verticals, but because they're bringing a new way to do things, right, they're able to capture market share. And we like that setup. The second area that we like are companies in Japan that are basically have great businesses domestically, but then are taking those businesses overseas, right? And that could be, precision tool manufacturers, or it could be a company that's like a sushi chain, for example. The third area that we're excited about are basically growth opportunities due to demographic decline in Japan and also digitization, right? And you're seeing a lot of opportunity servicing both those kind of like markets. And demographic decline, we all know that Japan is an aging society, and there's like a bunch of products and services that need to be created to support that. And then digitization, that's been driven by the government. And also, I think COVID led to an inflection point in adoption of digital services, whether it's by retail folks basically using cashless payments, or it's by companies embracing the use of software and cloud in their businesses, right? Because they had to because of COVID. And that's really accelerated, that adoption, and as a result, growth rates. And then the government is putting in place incentives to encourage companies to adopt, for example, electronic invoicing, which is leading to cloud software companies in accounting and HR having a great opportunity. And then the fourth area is something that we started with, which is basically companies with hidden value on their balance sheets. That's the area of least focus to us, because coming back to, we started this podcast with, we like to find businesses that can build economic value year in, year out over multiple years. And many times those like hidden value companies tend to be just kind of one-time re-rating events.
We've talked so much today about a few regions, but there's a lot of other companies in your universe across other areas. One important area is the ASEAN region, which really has a diverse set of markets. What do you own there, and how would you compare the dynamics in those markets?
We think ASEAN is a very compelling region to kind of analyze and invest in, given the youngness of the population and the growth of the various economies, and a disproportionate amount of people coming in to call it the middle class in Asia by 2030 will be from ASEAN. And, India will be the other kind of big area. And so for us, when we look at ASEAN, we're really trying to focus on trying to find the best consumer companies or consumer domestic opportunities that we can find in the various markets. And sometimes in each market where a company is basically taking a regional approach. One of those businesses that we own today, that we've owned for a number of years, is a company called C Limited. C is the largest e-commerce company in ASEAN. It also has a Latin American presence as well. It has a large gaming business where they're a developer of games and a distributor of games. And they also have a fintech business, which is called C Money, which is a business that they've created to help their merchants and their consumers with their financial services needs. And so the way we think about this is you have a wonderful gaming platform, a business that's like Amazon's e-commerce business, and then a C Money business that can be like Nubank if it does a good job over time. What's exciting for us today when we look at this company, and the reason we still own it, after having bought it at $5 billion or just below $5 billion in market cap, and it's a $50 billion company today, is now it's become a company that was focused on growth and did a great job of delivering growth, to a company that's now delivering growth, but also with profitability. So if you look at the past several years, this company has compounded its revenues at about 68% a year and its gross profit at about 87% a year. And going forward, we think it's going to compound its revenues at 20 to 25% a year, but its profit at very, very high rates, approaching 100%, given it's coming from a very, very low base. So if you just take that and look at it from a metric perspective, today you can value this business, which is this growth company, on PE, and the PE numbers I think will surprise you, where it's below 15 times earnings next year and below 10 times earnings the year after that. And so for us, what's exciting today is that we still have the growth opportunity intact, And a business that's reached a meaningful scale, and just to give you a sense of that, they'll probably do about $100 billion in GMV this year, and they'll continue to grow after that. But in a business now that's focused on monetization because the competitive dynamics of the market are more set than they were before, and they've done a good job of keeping themselves in a leadership position in these markets by a factor which gives them an ability to increase monetization, but not be worried about market share losses.
Interesting. Let's talk about indications that investor interest has waned. If you looked at who are the holders of C, this fast-growing e-commerce business in Southeast Asia 3 years ago versus today, it was probably 40 or 50% owned by US and European hedge funds. And today you can only find a couple names on their top holder list. It's certainly been shaken out pretty materially. If I could go back, one quick question on Japan, and maybe you could answer more broadly for the portfolio, but how do you think about currency? Do you hedge the currency? When would you hedge the currency?
Yeah, our default position is our currencies are unhedged. The compounding potential of the businesses that we own, I think, offset that. And we've just kind of left it that way for a number of years now.
Do you think the yen's cheap?
The yen was certainly cheap when it was in the 150s. And I think it's in the low 140s now. It seems, I'm not a macro guy, I'm not a currency guy. It does seem that if you get increased movements by the BOJ in terms of increasing interest rates in Japan and the Fed is moderating, you could have the yen appreciate here. I'm answering your question without answering it.
That's fine. Yeah. Look, we look at it on a purchasing parity basis. Yeah. It does appear cheap. And as you say, it was maybe cheaper when it was higher, but when there was so much speculation in it. My final Japan question would be, from your perspective, again, you're not a macro guy, but how over do you think the yen trade is? Like, could we see a return to the yen carry trade that would lead to further devaluation of the yen or what have you? Or do you think people have kind of been shocked into this is a real correction or kind of back to more normal?
I think you could see a return to it if you see a situation where, you have, a new prime minister coming in clearly in Japan, and you have the Fed on their path now. And so actually you could see a return to this carry trade depending on what the Fed does and depending on what the BOJ does.
Vineet, we typically close our podcasts with things that we're doing in portfolios, favorite ideas. I know we've covered a lot of ground today, but maybe you could share what part of your portfolio is most exciting today. Where are you spending the bulk of your research time? This could be a region, it could be a company, it could be an industry, but what's got you most excited?
For us, it's hard for me to just pick one. So I'm not going to pick one, but I'll answer it in hopefully a way which is meaningful nonetheless. I think that ASEAN is super interesting because no one cares about it, it seems. And if you look at 5, 10, 15-year data from just a economic standpoint, every indicator and the three places that we care about at least, which are the Philippines, Indonesia, and Vietnam, have improved. And I think the investable opportunity set has also improved. The companies have scaled meaningfully and valuations by and large have derated. And if you think about where there is a considerable portion of the population that's under the age of 35, that is basically Indonesia, the Philippines, Vietnam, and India, which, if you think about it from a GDP per capita growth rate perspective, nominal GDP real growth rate perspective, that percentage of the population being that young is going to drive a significant amount of growth. And if you've at scale that you're at today and valuations and confident then in the 3 to 5, 10-year perspective, there's a huge opportunity there, I believe. The problem is no one cares about it. And that results in the fact that liquidity is quite challenged in those markets. So you have to be careful about how you pick your spots. But you can literally go buy like the number one companies in some of these markets for very little in terms of overall market cap relative to their positioning and valuation relative to their fundamentals. So that's really exciting for us in terms of incremental research effort. Japan remains exciting in the small mid-cap space because I think fundamental value just continues to accrue in some of these companies and is largely being ignored by the market given where the skews are. And then India has been this interesting market because I think breadth and depth of market is increasing quite significantly, which means there's just more to do for folks like us who are, bottom-up stock pickers and who spend a lot of time doing a ton of primary research on companies. And still, if you look at our investable universe, you look at India, these markets in ASEAN I talked about, in Japan, In some of these markets, you have like 40 to 45%, if not 50% of companies that don't have analyst coverage. And the ones that do have analyst coverage have few analysts covering them, right, for the most part. And that's an exciting place for us to be as a stock picker and folks with the type of investment process that we have. I didn't answer your question with one thing. I talked about three, but hopefully you get a sense why.
That's very helpful. Like any proud parent, you've done a good job praising all of your children.
I love all my children equally. One's clearly in detention, which is China. So,
Yes, it's all right. Well, thank you so much for joining us today. And I know it's quite late for you where you are. I hope you'll join us again. And thanks again for 20 years of partnership and a great conversation today.
Well, thank you very much for your time and for inviting me to do this and for the partnership as well.
Erika, that was a great conversation. What are your main takeaways from it?
Yeah, I agree. I mean, it's fascinating to listen to him. I mean, clearly on the ground, 26 years in Hong Kong gives you such a different perspective, one that, we and investors don't necessarily have. And, I think a lot of his time has obviously been focused on finding long-term value creation opportunities. It's just such a big universe to get your arms around. I mean, there's 1,000 touch points that he has with companies. But I think if you distill it down, I mean, it sounds like a lot of the work and why they've done so well and why they're finding attractive companies is they've been able to develop that partnership with management teams. And they're much more focused on the next 3 to 5 to 10 years. I thought it was really interesting that, you said to him, you can't trade your portfolio for the next 3 years, that it would be no problem. So it just speaks to the quality focus that he has. Just a couple other points, Sid, that I thought were interesting is just that tailwind from corporate governance and transparency and just improvement in that human capital and capital management is so critical in return on equity and performance of these companies over time. I think it is really interesting on the small and mid cap side that on balance, it's not the same view that we've had here in the US, but the difference is a lot of these companies don't have analyst coverage. So there's just this attractiveness there that these are kind of undiscovered, underfollowed. I really did like his cautious interest in China, but I think to me, it sounds like he's looking for that inflection point. But look, a lot of these regions valuations have derated and, that he seems pretty excited about it, but I just don't know what that inflection point is for investors going forward. I mean, we've talked a lot about Japan and how interesting that space is now. Sid, what are your takeaways?
It actually kind of reminds me a little bit of our conversation that we have with Lauren from Impactive looking at US small caps, which is if you've bought high quality companies that are generating free cash flow and they don't have a lot of debt, so they're in control of their own destiny. And if the stock prices go nowhere, eventually you start getting paid back a lot of the market cap in cash on an annual basis. And so when you're talking about a portfolio, you only have to look a year out and it's got a 7% free cash flow yield that's growing 20, 25%. That is very attractive relative to what we're seeing in US markets in smaller companies. And then forget about comparing that to the large cap benchmarks, which are trading at basically the same multiples with lower free cash flow yields and much less growth. So it is interesting. What will bring attention back to the space, as Vineet said, maybe it is the broadening out that we're all, I guess, hoping for and expecting if we see an engineered soft landing here, or if there are any hiccups in the AI story. I thought his comments on Japan were really interesting. I love the fact that he was buying stocks as they were selling off during this yen carry trade unwind, and that he views it as a healthy reset, which I think we do as well, rather than seeing it as kind of a concern that this just happened. You say that we took out some of the froth and had a bit of a reset. It was interesting. He thought the trade could be put back on. And then when talking about ASEAN and thinking about his portfolio, he's got half his entire portfolio in ASEAN plus India. India is the biggest chunk of that. But these are markets that, as he said, they're very large markets, lots of people, close to 2 billion people, very young and growing very fast. So when you think over the next 5-10 years, places that are young, growing very fast, and starting at still very low levels of income and could be on that China trajectory that we saw for the 20 years that have just passed. They could be on that for the next 20 years. I think that's very interesting for us as kind of long-term investors.
There's not a lot of places where you can buy number one and number two companies within their respective industries that are growing at greater than 15 to 20% earnings growth, but are trading at a fraction of that growth. But, I guess there's reasons why investors have been patient. And you asked a lot of those questions about tariffs, about economic instability, liquidity in the market, just this movement of capital, of nervousness in China. So investors have now moved to Japan, and there's just always this flow of capital in those regions.
It'll take patience. In our prior conversations with him, he's always mentioned that the biggest risk to him is the patience of the capital that's investing behind them. But I think, in my view, being with a specialist on the ground who has the time to sift through these thousands of companies and is just constantly on the road traveling, meeting with companies, and having a kind of dedicated allocation to it, rather than hoping you'll get a little bit of this through large cap companies in a more global allocation, makes sense. But like other areas of the portfolio today that aren't AI or cloud focused, they're going to stress all of our patients. But that was a great conversation.
It was terrific.